This week on Generating Alpha, I sit down with none other than Joseph Edelman, founder and CEO of Perceptive Advisors, and widely regarded as one of the greatest biotech investors of the past 2 decades, for his first ever podcast interview. Since founding Perceptive in 1999, Joe has built it into one of the most successful healthcare-focused investment firms in the world, with a track record that ranks among the best of any human-managed hedge fund over the past 25 years. Joe's investing approach is rooted in deep scientific understanding, paired with bold, high conviction decision making in one of the most volatile sectors in finance. Under his leadership, Perceptive has backed some of the most transformative biotech and life sciences companies that are changing how we treat disease and advance medicine. In this conversation, we explore his early life, how he developed his passion for science and investing, the founding and evolution of Perceptive, how he navigates uncertainty, and what it takes to win in one of the most complex and dynamic corners of the market. I had a lot of fun making this episode, and I hope you guys enjoyed listening to it. Thank you. Thank you, Joe, for joining me. I really appreciate it. Thank you for coming on.
Absolutely.
I want to start off where I always start off. Just tell me a little bit about your childhood, your upbringing, where you grew up.
Yeah, I grew up in the city of San Francisco. My dad was a professor of biochemistry at UCSF. And I went, he was a pretty well-known scientist, member of the National Academy of Sciences. And so I grew up around that kind of, that's as far as the science, now I have analysts who have PhDs and MDs. You do need that, and that's become more important as time has gone on. My background is generally more psychology. So I went to UCSD, University of California, San Diego. I majored in psychology. And then I moved to New York at the age of 25. It's a bit of an unusual story. I didn't get my first job as an analyst until I was like 32, and I just had an MBA from NYU. And we can go into that. I was really like a part-time analyst at a very small firm, but I got some attention for a short sale actually on a company which had a 5-minute AIDS test for AIDS, HIV. And what happened was I pursued a master's in business at NYU. And as part of that, in order to get, because by that time I decided I'm not going to try to go into science. I started a PhD program in pharmacology, and then I realized very quickly it wasn't for me. And I thought, maybe biotech analysis would combine, scientific interest and interest in business and making money. And so as part of my MBA, I wrote a master's thesis for a biotech analyst on diagnostics. And from that, I learned enough to know that, immunodiagnostics, things like HIV tests and hepatitis tests, and other in vitro diagnostics, was not well understood on Wall Street. So anyway, my first job there was a company, Cambridge Bioscience, that had a 5-minute test for HIV, which right on the surface is a stupid idea because you don't need an immediate answer. What you want is complete accuracy. You don't want to tell somebody who has HIV they have. So the way this is done is they do these tests that take, a day, and then they repeat it before they give you an answer. And then they confirm it with a Western blot. So maybe 48, 72 hours later, you get an answer, but you get the right answer. Do you have it or not? And that was one of many reasons I thought this would not sell well. Maybe I'll go into a little more about it, because that really taught me the most important lesson of the stock market, something I call repeat surprise. What happened was this company, Cambridge Bioscience, the two sell-side analysts on the street had, I think it was like 25 million and 30 million in first year sales. So I saw my chance to somebody to pay attention to me, because believe me, nobody knew who I was. And I said this would sell less than $1 million. It was an interesting, because it was a one-page report, and I just made my own rating, which was immediate sell. So the first line was really obnoxious. It was, if you own this stock, you must sell it immediately. That's the kind of, and people got really pissed off who held this stock. I was completely naive about some of this. I never visited the company, never talked to the company. And here I'm telling people, you got to get out. But I said it would sell less than $1 million. The first quarter, I don't know, maybe it was $50,000. The two analysts who were, 30 and 25, all of a sudden they're very biased. So the company is telling them, well, we didn't start our marketing campaign or something. So they slashed their number. But what do they go to? They go to 15 million or something like that. And I'm thinking, I'm at $1 million. It's not even going to do $500,000. So I lower my number to 800,000. Now we're at an average, if you look at a consensus, of 14 million. So this is where the repeat surprise comes in, because the bulls were so biased. And if you think about that, this gets more extreme depending if you came out with a buy rating, 2 weeks before the quarter. How are you going to go from 25 million to 500,000? You're not going to do it. You're not going to let yourself think it's possible. You're not going to. So now the average is still way too high. The next quarter, they do whatever, 100,000. People have to lower it again. And I put the sell on at 15. I unfortunately went to a hold rating at like 4, and it ended up in bankruptcy at 0. The stock went to 0. The CEO, CFO ended up in jail for trying to cook the books. And so it was repeat negative surprises caused by two things: the bias of the bulls, wanting to believe, the glass half full. And then in this case, the liberalism of the bear. In other words, I didn't need to go down. And repeat surprise, you still see it in the market. I knew it would become, less, because market has grown tremendously in efficiency. But for instance, Amgen, which is the world's biggest biotech company, they had 18 positive surprises in a row. And why? Because what would happen, they were very good at keeping their first drug, Epogen, was blowing away everybody's numbers. And you try to raise your numbers, the company would call you and tell you, you're too high. You're going to embarrass yourself. And they would convince you that, and sure enough, because here positive surprises, in that case, the bulls can be very conservative. They can be low, which is really what they want anyway. It's not that they're looking for accuracy. The company can be conservative, make sure that the numbers are achievable or beatable. And then bears are biased in that case. So they're thinking it's one off. They're going to miss next quarter. So they don't raise their numbers enough. So in the first case I gave you, people weren't lowering enough because of this combination of bias, in my case, being too liberal with the number. And in the case of Amgen, they wouldn't raise their numbers enough because company, all that. And by the way, I was a sell side analyst. Give you the background. I went because of Cambridge Bioscience. I got a job at Prudential. Of course, I was a terrible sell side analyst. I was literally the lowest rated biotech sell side analyst in history. I'm not, I hate to say I'm lazy. I don't work super long hours. So a lot of what I was able to do was I surrounded myself. There was a guy, Wayne Rothbaum, who I was a mentor to, who was a workaholic. And I was really sort of teaching him more the two things: repeat surprise was very important, and then just the basic perception reality. That's the so if you look at a biotech stock, or any stock has the element of perception reality, but in the case of biotech, there's three questions you're trying to answer. Does a drug work, which is phase 3 trial? Will it be approved, which is on the PDUFA, what's called the PDUFA date, where the FDA says approved or not approved? And then will it sell enough to justify a higher price? Okay, so you've got three basic questions. Everything else is perception of those things in between. So you spend years, a certain amount of early stage data, but basically the perception, will the drug work, is what's driving the stuff. Then it turns to, let's say it works in phase 3. Will it be approved? Which is sometimes simple, but oftentimes not. And then after that, on approval, will they meet? And we can talk about how you value things, but will they fall short of consensus or beat consensus? And ultimately, will they produce enough earnings to justify a higher stock price? And everything else is perception of those things. Now, we're in a pretty long bear market for biotech. Basically, people, I think, and I worried about this, obviously not enough along the way, that people would get discouraged over time, that there'd be less, simply because it's a very easy place to get blown up. And, if you're trying to answer all three questions, which ultimately you need to do, right? Because the ultimate reality would be the earnings. The ultimate would be like a discounted cash flow of earnings. That's very hard to predict all three of those things. It's very, very easy for your drug you think is going to be $1 billion to be, 500 million. We do a tremendous amount of work there, but it's still difficult. And of course, they're going to discount a certain level of earnings. That's just the way the market works, right? If people think it's a $2 billion drug, it'll be discounted somewhat from there, but people are not going to value it as if it's going to be 200 million. They're going to pay. So as time went on, I think in the last 4 or 5 years, it's a combination of inflation, interest rates, which the reality of those things, how much they affect, is less than the perception. But that's like a signal for people, like, don't be in simply on economic grounds. For instance, if you have inflation, then $1 today is relatively worth more than $1 in the future. So it's not been a popular group, but now I think it's actually at a level where you've got winners and losers. But that's not the kind of easy environment where you just say buy biotech. That I think you don't want to do. I think you need to, get a story where you can have some, either it's commercial, and for instance, we're big in a company, Verona, where you think that the sales are going to keep beating numbers, the earnings are going to justify a higher stock price, or if it's developmental stage, where you've got a very good chance of, the drug working and so forth. So maybe I'll stop there.
Putting all those principles kind of into practice from a very high level, if I was sitting in like a room with you guys during your research process versus a room at other biotech hedge funds, what would you say kind of separates the research process? What would I see differently on a high level with you guys
Not
versus other
much.
people?
Not
Not
much.
much?
And no, probably not. I've never, I tell analysts, because analysts, it's stressful, and there's a tendency, that they want to pick out something in the story that's either they can, right or wrong. Unfortunately, the market being more efficient, you got to look at, you really got to look at the whole pipeline. But I would say that the same, particularly at hedge funds, that they're debating the same things. Honestly, I think the market is extremely efficient. You can see it often in the stock prices. So I don't think it's tremendously different. We may be more long-term oriented than, say, a pod. You know what a pod is,
Yeah.
like Steve Cohen's people.
Yeah.
More of a shorter term thing. Where very focused on the catalyst. Maybe they're willing to bet very big. And by the way, catalysts don't automatically work unless there's a difference between perception and reality. If everybody thinks the drug's going to work, the drug stock may not go up on positive results. But I make all my analysts, I'm probably more focused on them modeling. I got everybody here, you have to model it, and then we compare all the models. So this would be long-term 10 years income models. I warn them that I don't believe their models because their models are 100% wrong by definition, but it's still, first, the model gives me, if it is on the right side of things. Let's say one of my analysts think this is a $2 billion drug and their stock's being valued at $1 billion. Then, if it's $1.5 billion, it still may be a good buy. It allows me to compare for weighting purposes, where today's market, a lot of them, for instance, I would use a discounted cash flow model, right?
Yeah.
I would use that for a one product company like a Soleno or something, or a company where there's no reason to put a PE multiple, and you could get in trouble because if you had a company which you got to a point where it was earning $1 and then $1.20 and then $1.50, whatever, you might have a 20 PE that's somewhat reflective of its earnings growth. But if you have a company that's $1, $1.20, $1.50, and then 50 cents, the market will discount that.
Yeah.
That won't be a 20 PE. That won't be a 10 PE. That might end up being a 5 PE. So for single product companies or companies with short patent lives, that's what I'm going to reflex to mostly. On the other hand, we have other stocks, where they have pipelines. So you could deal with that, which might have value. They might have negative value or positive value, by the way, because if they're throwing their money away, which happens all the time, that's not good. But let's say example, like a company like a Nuvalent, which we're in, which we think has multiple good drugs. So that I might look when they're profitable and say, hey, they can do, I'm going to actually say at that point in time, that might get a PE multiple, 20 or whatever, depending on the earnings growth at that time, because people will still be excited about what's coming up. The other way you could deal with that, if you wanted to, is just take the DCF and then add on a value for the pipeline. So this is to get long-term target prices. So when you think about short-term and long-term, often that's perception, reality, not always, but short-term's perception, long-term's reality. One of the things that gets analysts stressed, among many things, is I keep saying, I want a short-term view and a long-term view. That's what I'm going to come with. And then when you say, well, what do I value it on? A short-term opinion. Normally you might say, well, short-term is all that matters, right? The problem is, what's your confidence level? So in those things. So what I would say the ideal stock is something that you believe it's going to go up on short term. Let's say short-term perception, or in the case of Verona, quarterly earnings, and you believe long-term it's worth a lot more. Those are hard to come by. A lot of times you have something where you say, I think, let's say it's Edgewise, earlier stage company. I believe in this long term. There was this hiccup in the trials, but between the two drugs, I have high confidence at least one of them will be approved within 5 years and will sell $1 billion. But short term, the data was slightly funky. And even though I think they can get past that with further testing, I'd have to get in the details, but there I'll put more value on the long term because that I actually believe in. Say in that case, let's call it the 70% likely it's going to work long term, but it's 50-50 short term. So maybe I reduce the position. One of the things that there's many things that I think maybe differently than a lot of people. I don't think in terms of, first of all, buy low, sell high, throw that out. That's just a bias. That's not worthwhile. All you got to do is say, independent of whether you owned it in the past or you sold it lower, sold it higher, or what the stock has done, is say at this point in time, objectively, and this is the most important thing, is just uh, relentless objectivity, which is hard to do because it increases your uncertainty. But is it worth more? So, for instance, you don't want to get into biases. Like, let's say you were an early investor in any, Apple computer, and you're like, it was $1, it went to $2, and you were worried about a quarter or something. You're like, I'm taking my profit off the table. 100% gain, whatever. You're not likely to buy it back at $100. It's too painful.
Yeah.
But that's the kind of thing fascinates me. I'm willing to I'll get to a point. There was one time I remember where I kept buying high and selling low 3 times in a row. And I'm like, I'm out of here. I'm done with this shit. I don't understand this stuff. But theoretically, you shouldn't care what. And why does technical analysis work? Technical analysis, if you reduce, it's like the higher it sells for, the more it's worth. I mean, it's kind of stupid in a way. It should be if buy low, sell high. If it was all Warren Buffett, um, you would never buy something that's up 100%, right? So
Yeah.
you don't want to think that. You just want to think objectively. And then you have to be willing to change your mind because I give you the example of repeat negative surprise. So all new information, meaningful, not just, the stock acted a little funky one day, uh, can be reflected in position sizing. So that's it. So one thing, no buy low, sell high. And then as far as you don't, you can go from 80% confident to 60% and not necessarily sell the whole position. Right? It's people want to say, I like it or I don't like it. This is one of the many things people need. They want to buy when it's cheap. And I've seen just insane examples of that, including ones that I was in a company called Pharmacyclics. We bought it $1.50. There was one piece of data we didn't like. My friend Wayne, there's a book written about this, by the way, called For Blood and Money. Um, he's a very convincing guy. I mean, at 6.5, he's like, drug's not going to work. You got to sell it. So we sell it. Then, six, now it's sold at 6.5. It goes to like 10. Then he calls me up. He says, well, I might have been too cautious. So what did I do? I bought back maybe half. Couldn't buy, even consciously knowing there's going to be this bias because you think about it, you bought it $1.50, you told it 6.5, you're buying it back at 10. What if it goes to 4 now? You turned a winner into a loser. But that should theoretically still be a bias. Because what difference does it make if you lose money on company you once made money in, or you lose money on some other company because you didn't want to go back into the same one? But we didn't. And then because we were so early, we were the victims of essentially what repeat positive surprise. When it was $1.50, I tried to get the analyst the blue sky target. Like, what if this thing is just incredible? Everything's, and he got to $18. And I look back on it, I go, might have. And so what happened, maybe that was too low because where we were, the relativity, we were buying it so low. And sure enough, like 2 years later, it ended up $272. But we sold it at 6.5. We made 4 times our money. And by the way, that traumatized Wayne. He then started another company with a similar drug, better, but he sold that for $7 billion. So I tell this story like he got us out too early, but he went on from making me, $20 million to making me $800 million. So he did okay in the end. But nobody's like him. Nobody's quite like him. He's just relentless person. And um, anyway, so yeah, so let me stop there. What?
You guys have, I mean, I've heard you guys have like 200 plus positions at any point in time, but
Yeah,
you're also somewhat concentrated on the positions you believe in. And you've kind of compared that to like a poker analogy. Can you just talk a little bit about like diversification and risk and how you think about sizing positions and
yeah.
concentration?
I don't torture myself too much. So people could look at, Charlie Munger, like, what the hell's with this guy? You can't have, you don't need more than whatever it is, 10 positions or 20 positions. That's all true. But when I go back to like my sizing is more about relative, if I still feel like, let's say, obviously one position, if I'm going to have a small position, it's liable to be very high risk, but have higher return than one of my bigger positions. So it has a
Okay.
different profile. Some of it is because, I like it to be a nice place to work and I see what's the harm. I'm not going to do something I don't like. I'm going to question the analyst. But there are quite a long list of biotech companies which, if the drug works, um, it's liable to be worth a lot more. These are earlier stage companies. And by the way, if you have 50 basis points or 100 basis points in a company like that, it could be a 10 bagger. You can make it's not like it's meaningless. It's not like buying 200, big pharma companies where you're just diluting to a point where you're an index and that's all you are. Um, right now, I have one very large position, so it's got the analyst nervous. I hadn't had that for 8, 10 years. I have a position at 20% of my fund is company Verona. And it fit what I said earlier, where they're beating numbers near term. We think it's minimum $3 billion peak, minimum $20 a share in earnings, peak earnings. These are pretty big numbers. Now it's gone from, you know, 20 to 100, but still $20 a share. You can do a discount cash flows. Um, on our most conservative number, it's still like 120. It's still above where it is. And my confidence is high. The reason I don't sell more is because I think they're going to beat the next quarter. I think it's, and I could go into that, but I don't know how much time you have, about how that sort of coalesces, because there was a point in time basically where the company got the approval. I never, because I'm a cynic, I always thought, oh, it's a drug for chronic obstructive pulmonary disease. Um, it is a small drug. I just dismiss things. I'm not the analyst. And I'm like, it's 500 million. And my two analysts are like, no, we think it's a billion. The company says, yes, we think it's at least a billion. They got approval. They're in our office. And the CEO, who I like a lot, he's got a lot of experience. He was number 2 at United Therapeutics, which is a successful company. And I said, David, you still think it's a billion? And he's like, no, it's billions. And I'm like, tell me more. Because it's at $20, it's reflecting maybe 700 million in peak sales. Well, he said, we've done a lot of early meetings with different specialists, and we're getting very positive feedback. And I'm thinking, that's interesting because he knows this space. I don't, but maybe that. And I said, do you have any outside market research firms? And he said, yes, Trinity. And I use Trinity. Like, what does Trinity think? Billions. So I get Trinity to do an analysis of it. And sure enough, they come out with $3 billion. And then every time we're meeting with them, because now we're doing a lot of our own calls as well as Trinity, different ways of doing it. How much of this drug would you use this year, next year? You can try that. You can compare it to an existing drug where the prescriptions. So Trelegy is the most widely prescribed COPD drug. How much use versus Trelegy? Something like that. And from the pulmonologist, and then you adjust for the price. and Trilogy is like 1/6 the price. Most of them were saying we think ultimately it will be about the same number of patients as Trilogy. Well, if you do that math, all of a sudden you're at 15 billion. You're not at 3 billion. Okay, well, that seems a little unreasonable. It's too much Medicare pay. There's other reasons. But then when I say this to David, I'm like, I can get to, 13 billion. I'm just sort of pricking the tires. I'm just saying, like, how much is he going to push back? Now, he knows this game. He's a smart guy. But he says to me, it wouldn't be unreasonable to think it's 10 billion. And I'm thinking 10 billion, it's going to be $1,000 stock. So then I'm like, even though the stock's going up, I'm pressing it because I have so much room. If you look at it now, you say, well, if I held it long term, what's peak sales number would I absolutely need for the stock to not be selling for less, say 5-6 years from now? And that would be under 2 billion. So I've still got room. On the other hand, if it's a $3 billion drug, it might be a 10% compound annual return. Nothing great. So maybe it shouldn't be 20%. But at that point in time where I thought they're going to beat near-term numbers. Oh, by the way, when it comes to repeat surprise, you gave me the perfect answer. David, I love that the analysts are, in the threes, 3.5 billion, but we can't come up with less than 5 billion. I said, why do you think that is? That's a little bit of a pressure question. And he's like, well, it takes a while for analysts to catch up. And I felt like saying, good answer, because that's the phenomenon of repeat surprise, where he's basically saying, no, they're too low. They just haven't figured it out yet. So now, could he be biased? Of course. Could he be being promotional because Big Pharma is looking at him and he wants to tell the world he's got a $5 billion plus drug? I can't totally answer that. But every time I've talked to them, they're smiling. One of my analysts says they're chirpy. They seem totally unafraid of expectations for the quarter. So that's how I really press that. Then you go down, I've got Arcellx, I've got other ones, mostly some pre-commercial company, Ascendis, which is commercial, which we think will beat. Usually, if it's commercial, you're going to want to think that they can beat consensus, right? Where it can be complicated is maybe, they miss by a little bit the next quarter, but you still have reason to think that ultimately they're going to get sales levels that'll justify much higher stock price. But then you're back to the short term, long term. How do you integrate that, what you're learning as the quarters go on, with what you're seeing in the stock price? Obviously, I don't like it if they miss a quarter, partly because if the drug was going to do so well, the company should have been able to sort of manage expectations like Amgen did, where they can keep beating. Because if they start missing, is it because they're scared of what their stock will do or something? So sizing, it's an art. It's not. I don't do it scientifically. You could do it scientifically simply by there's a program that I didn't buy. I thought it was, but where they basically, you say, this is the upside. Is this $20 stock, $40 in upside, and $10 in downside? My probability on the upside is X. My probability on the downside is Y. And it will spit out. And then you put parameters. I don't want to be more than 15%. It will tell you what your sizing should be based on the probabilities and the upside downside.
So I feel like you've almost given a masterclass on biotech investing. I think at this point I'm ready to raise
Yeah.
my own fund to invest in biotech. But I don't want to take too much of your time. So I have one final question I
Yeah.
ask every single one of my guests. And that is, if you had one piece of advice to give to, I'm 15, a 15-year-old today, or anyone that's young in high school or college, what would it be?
Specialize. It would be try as much as possible. Don't do quite what I did, in figuring out what it is you want to do, and then learn as much about it as possible. So in the investment world, it would be an industry. Uh, Being a generalist is, very hard, and you have to think about market efficiency. So you have to you have to think in terms of, well, how am I gonna? It's like poker. If you wanted to be a great poker player, I don't play poker, but you wouldn't like study all card games or study chess. You just spend all your time understanding everything there is about poker. That also makes you more marketable. Um, so in general, is try to find what you want to do early, and then if you can change, because you do want to do what you like.
Yeah.
You don't this is what Buffett type advice. Don't do for the money. The money is tricky because vast majority of fields people can make a lot of money. But what's more important is that you're going to enjoy what you're doing, um, and hopefully it's something you can make decent money. But by the way, happiness is much less correlated with money than people. They just don't accept. That research is very clear. It was like maximal happiness was $125,000 a year. It was low. It was
Yeah.
not something you should. And I can tell you from personal experience, I'm very materialistic. I, own multiple houses, but it's all diminishing. It can go in the opposite direction. I know it sounds ridiculous, but when you have so much money, you can buy anything. Nothing is that exciting anyway.
Yeah.
What you want is ideally enough to, if you have kids, send them to school, maybe a second house. I've told anyway, as people have asked me, like, what's most important once you start to make money? I usually say, well, business class on an airline and a decent vacation home in the Berkshires, and then you're kind of done. Because after that, it's like, who you marry, who your friends are, your health. So, but yeah, specialize as far as a career as quick as possible, learn something in depth, and then you can use that. And then if that doesn't work out, you got to, I think, flip around and specialize in something else. But you can't be jack of all trades.
Thank you for doing this. It was really incredible, and I think a lot of people will learn from this.
Okay, thanks, Amir.